they will do it individually during the debate. But what I can tell you is that you will have a very impressive panel in front of you of really best-in-class experts, and collectively they represent way over 100 years of very significant experience in the funding of growth companies.
All right. I think this mic is also working, so welcome to all the panel members. Please take a seat. So what is the purpose of this panel? Is to introduce you indeed some different types of investors. Some of them you might never heard. Also, we see, again, I think in general the entrepreneurial ecosystem has been expanding in the past couple of years. So what I would first like to do is ask each of the panel members to briefly introduce themselves and to share with you what type of financing, or what company they represent. So I would like to start. Let's maybe start with Jochen. So welcome, Jochen. Very short introduction to yourself and the company you represent, the investor.
Okay, thank you. Hi, so my name is Jochen Hond. I have a background as a tech entrepreneur. We had an exit a couple of years ago. After that, I did a lot of mentoring and coaching for founders of startups and scale-ups. I did that with Scale of Founders in the past. Today I'm doing it with NOAH. I'm also the chairwoman of NOAH. But my main activity here today is that I'm an associate with Shaping Impact Group, and we are an impact investment VC.
So then we have Paul. So please, Paul, introduce yourself.
Yes, I'm representing something new on the market, Capital Fusion Group, which has been founded some weeks ago. And our goal is to help scale-up companies with proven technology, proven concept, to help them through an IPO to get the necessary money to finance their growth. So the IPO is not being used for an exit, but is being used for collecting the necessary money. And we are focusing on markets where there is enough money available for the time being, and that should be London and that should be New York.
Welcome. So then we have Henri-François Boet from European Investment Bank.
Henri-François Boet from EIB. My background is mechanical engineering, business administration. I worked in consulting, startup industry, and then I've worked about 20 years in the financing of academic spin-out companies and independent companies, financing them with venture debt. So equity type financing. And I work for EIB, so the European Investment Bank, located in Luxembourg, a European institution belonging to the 27 European member states.
Which is probably the biggest investor in the venture capital ecosystem in Europe. Then we have Ludwig Lorenz from Capital.
Yeah, thank you. I'm Ludwig. I am partner at Capricorn Partners. We are an asset manager based in Leuven, here in Belgium, of course. We are a house with many rooms, as also you used to say. We manage quoted funds and venture capital funds. What does that mean? We invest in quoted funds that are freely tradable, where you and I can buy stocks off, and that also invest in publicly quoted stocks. Maybe not so much the topic of today. The topic of today is venture capital, and also venture capital we manage our funds active in three sectors: digital, health tech, and clean tech. And I'm a partner responsible, together with my colleagues, for the clean tech investment practice.
And then we have Robin Mees from PMV, which I have shown in the statistics was one of the most active investors in 2024.
Yes, thanks. So I'm Robin Mees. I'm the senior investment manager at PMV. I'm part of the equity investments team. So as Ludwig said, PMV is also a house with a lot of rooms. So the equity investment department takes direct equity investment into startups and scale-ups, but we also have within PMV, of course, guarantees, debt instruments, etc. But I'm part of the VC team.
And the question I have now for each of the panel members is, what specific financial instruments do you offer to the entrepreneurs, and what is unique? So what is your USP if these entrepreneurs would talk to you? So let's start with you.
So at Shaping Impact, we invest in equity directly. We invest in early growth companies, B2B.
We switch off those because those don't work well, we will use those mics.
Okay, will work, yes.
Okay, switching. So B2B companies, early growth, ticket sizes 250K up to 1.2 million euros. And as I mentioned, we are an impact fund. So we invest in the S of the ESG goals, so in the social impact. So all the companies we invest in have a positive social impact with their product or services. What does that mean? For example, we have invested in a company that does deepfake detection. We've invested in a company that has an unbiased hiring platform, so more people get equal chances in the labor market. A platform for debt counseling, schuldbemiddeling. Or we also invest in a company that makes AI decision processes more transparent. So the social impact is one of our USPs, but it can be very broad.
So then we have Paul. Paul, can you please explain, you already did a little bit, but what is your USP? Because this is, I've never heard about what you were doing before I met you a couple of weeks ago.
Yeah, it's, we are a group of existing, working, still active CEOs around the world. Those CEOs, they have the opportunity, or not the opportunity, to make very interesting deals. Because if you want to have an impact in a deal in the US, you have to invest several tens of millions of euros, which those CEOs don't have. So what they are doing now is they are putting their money together to make sure that they can have a bigger ticket into a scale-up. And because the competition in scale-ups and getting money into scale-ups in the United States is much bigger than in Europe, they decided to come to Europe and to see if the market here gives them some very good technology companies with a high profile. And what they are doing is very simple. They are bringing their know-how into the company together with bridge finance to get to a stage where we are going to decide if we want to do an IPO for getting the necessary money to have the next level of growth, or finding other ways of financing the next step.
All right, I think that's clear. Henri-François, you're into venture debt, which has been growing a lot in Europe. Can you explain what exactly do you do?
Maybe for the context, venture debt is about 1 billion, a little bit more than 1 billion euro per annum that EIB does. But it's really the top of the iceberg. EIB does between 70 and 90 billion of financing throughout Europe, mainly large projects, public-private partnerships, project finance, etc., and all for projects and companies that meet the European policy objectives. The main one being the green transition today. And we also, our daughter company, the EIF, also channels more than 10 billion per annum through guarantees and through its investment into venture capital funds into the economy. So venture debt, this a little more than 1 billion, it's across different sectors: biotech, clean tech, ICT, deep tech industry. And we basically take the same risk profile as later stage venture capital funds. So it's in companies that are not yet bankable. They cannot go to their house bank. Companies that are either pre-revenue or cash flow negative, typically. But however, companies that have a unique technology, a unique product they are developing, and that hence address a need, a market segment, and that have the credible business plan to be in this market and to generate cash flows that repay the debt. So typically we would finance 20 to 30 million on a company that has at least 40 to 60 million, so 2 times investment plan over the coming years. There is the word commercial or venture debt, commercial venture debt out there, which is often short-term financing to get to the next funding milestone. Our venture debt, we should have called it like long-term venture debt. The companies have about 3 years to take the debt, and then they repay it in 5 years later. So it means in year 5, 6, 7, 8, or they have some flexibility on it.
I think that's quite clear. Ludwig, here not new with Capricorn Venture Capital. Can you? I think most people will know. Can you briefly explain what is unique? What is your USP to the entrepreneurs?
Well, we provide equity. We don't provide debt unless we are already a shareholder into the company. So we manage funds from, let's say, 30, 40 million to 100 million, typically. And we, in the first capital raise, contribute ballpark numbers 1 to 5 million, and we reserve ballpark numbers depending on the specifics, about to 10% of the fund's committed capital maximum to a portfolio company. And that gives you an idea about what kind of investments or capital we can deploy in your start and scale up. And then that brings me to the asset class, start scale-ups. That can be in early stage, when we mostly do that in the beginning of a fund's lifetime, and late stage companies that make a revenue, that can be profitable, but not necessarily are profitable, right? And we then take holdings of 10, 20%. We always take minority holdings. And then indeed, if we are in that capital, we work with you in the board of directors, and if there is a follow-on capital raise, we will participate if you're doing well, of course, and maybe also provide for convertible or subordinated debt to, let's say, fill that gap up to the next capital raise.
And Robin, what is unique about PMV and the type of financing you offer? Can you explain?
Well, first of all, we provide, my team at least, also equity. So we have within PMV, of course, debt instruments, but the team that I work for, we do equity-like products. I would say there's a few things that make us distinctive towards other investors. So first and foremost, we are sector agnostic, so we look to basically every sector. There's a few that we don't look at it, but basically we do everything from A to Z. When we pitch towards a company why they should take us as an investor, we usually say we're an evergreen investor. So that means we can go through stages. So we can go very early stage and follow on up until a later stage. So I think that's probably our main characteristic that makes us distinctive towards another investor.
But do you invest alone or do you typically co-invest?
We co-invest, of course, so if we invest with our own funds, because we also manage a few external funds as well, but if we invest with our own funds, we can only do a maximum of 50% of a capital round and 50% up to the cap table. So we usually co-invest with one or two other investors.
Okay, and then maybe a question for you. Do you typically invest alone, or if entrepreneurs raise capital from you, will that be with syndicates of investors, other types of investors? So who's sitting in the deal typically?
So we always co-invest. We can be lead or we can follow. Entrepreneurs that approach us, they consciously choose an impact investor because they want to safeguard the impact aspect of their venture. And we typically invest with other VC funds, but we also invest with, because we're quite early, with business angels or with family offices. We don't invest with corporates or with foundations.
And so why would you not invest with corporates?
Because in our experience, with a VC mindset, it's sometimes difficult for the long term.
Okay. Let me move on to the next question. Of course, an important point for all the entrepreneurs in here is how costly is the funding. So how costly is it, and what kind of control do entrepreneurs need to give up if they decide to work with you? And maybe let's first start with Paul. How costly are you as an investor?
We are paying our own costs, so that's something amazing. We believe in the file or we don't. If we believe in the file, we take the risk together with the management. Otherwise, we don't do it. If that leads us to being a lead investor, we will do it. But we also organize co-investments. But the lead has to go to an IPO. We are not going to invest 1 or 2 million and then stop. It's going to be a bridge of 1 to 5 million, getting at an IPO 40, 50, 100 million. Not the big tickets, and it's not the huge companies, but we want to go at the stage between 50 and 100 billion euros for the growth.
And the 1 to 5 million you provide, is that a loan or is that you take equity?
It can be the two. It also depends because okay, we are at the end. What's our success? Because that's also one of the potential questions. We are paid. Let's say our success is paid by warrants or options, which we take at the moment of the IPO.
All right. Henri, Francois, venture debt, that's kind of a new kid on the block, which is a loan. What are the typical deal terms entrepreneurs can expect?
Exactly. So EIB is a public investor, so non-for-profit. However, with venture debt, we take the full equity risk. So if we would not attach an appropriate price tag, it would be total state aid. It would be forbidden. So we price according to the risk, and that's very, very tricky because there is no market for that. We are alongside equity investors, and equity investors will have, I mean, you saw it on the previous presentations, they will have expectations in terms of multiple and return, IRR. So we as well, in function of whether our debt is, whether the seniority of our debt has some value or not versus the equity, we define, dependent on the business plan and the company, we try to define kind of what would be the risk level and the attached return. And what is, we think, quite good is that we try to get this return not from a fixed interest, where the clock turns whatever happens, but we want to align the interest, and hence our return comes much more from warrants, synthetic warrants, real warrants, or royalties in some sectors.
Can you explain that? Because I still think for some entrepreneurs here to understand how much it costs, are we talking about 10% expected return, 12%, 20%?
Exactly.
And maybe you can also explain the idea of the license-based fees, what you mentioned.
So, for instance, a VC on this type of operation will seek to do 5x, 5 times return over 3 years. And that's like a 30, 40, 50% IRR. There are some assets in that company. So we as a debt holder, we are being repaid in case of liquidation. Those assets might be worth something. So our position as a debt holder is preferable to the equity holder. Right? I get repaid before. And as a result, we can aim for maybe 15 or 20% IRR. And then what we do is we, for instance, say there is a fixed interest rate or variable of Euribor plus 200 basis points, like 5%, and the remaining 10% return, we seek to have it through warrants. And if it's a biotech company, we can, for instance, say, well, we have royalties of 2% of your net sales over a 10-year period starting commercialization. And then you can be creative if it's a fixed percent or if it's declining. So there are all sorts of interesting mechanisms to align the interest.
So each deal in your case will be customized. So the kind of deal terms will depend. Okay. Ludwig, what are the kind of returns?
Well, yeah, I have a great colleague here that I don't need to explain anything anymore, because indeed we expect such kind of equity returns. So for an entrepreneur,